All right. Thanks, Quinn. And thanks everyone for joining us today on your Friday afternoon here. As Quinn mentioned, we're going to go through some important topics, some important end of year items, and we're going to touch on a lot of different topics today. So before we get started, I just wanted to say that we'll also have an end of year checklist that we're sharing with you. If you're watching this live, we'll get this sent out when we send out the recording early next week. If you're watching this later on as a recording, just reach out to us and we'll get a copy to you. The checklist goes through a few of the more complex topics that we'll just kind of introduce here in the webinar. As you read through it, if you think there are scenarios that apply to you that we haven't talked to you about yet, let us know. We're happy to go through the details with you. We won't go through as much detail in the webinar on some of these topics today, since we're covering kind of a wide range of items, some for younger families, some for retired households. So I think the checklist is going to be a good complement to what we'll discuss today, not entirely just repeat what we said. But I'll just say again that if anything we mention here brings up a question or concern, or if the checklist makes you wonder if a certain item applies to your situation, please just reach out and ask us. We're here to help. And so the first item, maybe a basic but important one, is for the end of the year, just make sure you're taking advantage of any of those tax advantage savings accounts. All these accounts have different limits. There's extra catch-up contributions that are also available if you're over age 50 or 55, depending on the account type. And so if you turned 50 or 55 this year, this is kind of a common something that's missed. You know, you forget about that extra $1,000 you can put in a Roth or something. So this is a good time to check on that. And this is a basic concept, but we include it here for a couple main reasons. First, these amounts do go up every couple of years. So we do find that some people have prior year contribution limits in their head or just kind of miss out on that max amount. And next, we find that a lot of retirees that only work for part of the year sometimes forget about these accounts and Roth IRA contributions in particular. So perhaps you were high income for a while or even retired for a while and then just worked a couple months this year. Now you might be eligible for Roth IRA contributions. And that's easy to forget about when you haven't been able to contribute to these accounts for a while. And so this is just a good time to check up and make sure if you are eligible for any of these, you're taking full advantage of these accounts. And speaking of 401ks, there's a few good, just quick things to check on these every year. First, are there any new investment options that were added to your company's plan? We've seen this a lot recently as we review client 401ks or 403bs and other workplace accounts. There's a lot of pressure for providers today to offer better, lower cost options. And there's actually been a lot of lawsuits too against companies that have failed to provide these better investments in their 401ks. And so if you haven't signed in and looked at an investment in a 401k, maybe an old 401k that's just sitting out there, it might be well worth your time just to review and make sure you aren't missing out on any better investment options. Next, we had a few clients who had their employers alter or remove their company match, especially during the COVID crisis, just to save money. That match might have gone away for a year or so. Those are being restored and may or may not be the same as before. So again, just a good check to make sure you're at least taking full advantage of that company match and check that if it changed at all. And lastly, this is a good time of the year to go in and do a rebalance. As maybe you've noticed, it's been a pretty good year for stock investments, maybe not so great for bonds. And so we're seeing the need for a lot of accounts to be rebalanced. It's also worth checking to see if your 401k has an auto rebalance option available that you can just kind of turn on. It'll do it for you in the future. You won't have to worry about this in future years. One last item on 401ks here. The contribution limits for 2022 are going up by $1,000, which is a nice bump. And so if you are someone who's taking full advantage of this amount, you might need to or want to change your allocation percent starting, maybe change it now so it goes into effect for that first paycheck in January. I put a few numbers here for dollar amounts. per paycheck that would need to go into the 401k to maximize it, though you're usually setting a percentage of your salary, so it can be a little bit more confusing. If you need help or just a second check on your math to make sure you're putting in the correct percent, just let us know and we are happy to help. And since we're on the topic for other 2022 savings limits, as far as other accounts go, there's very little changes in other contribution limits for next year. IRAs and Roth IRAs are seeing no changes at all, though there is a bump up in the income limits to be eligible for normal Roth IRA contributions. So if you've been on the cusp of being able to make Roth contributions in the past just because of your income, that may help out if you didn't get a equal raise for this year. HSAs and health savings accounts are seeing just a small bump in maximum annual contribution amounts, $50 or $100, depending on if you're in a single or family plan. Nothing drastic, but these are really great accounts. So you want to make sure you're at least taking advantage of that amount of money. And just to wrap up with a kind of summary of the variety of deadlines that exist for the various types of accounts that we see most common with our clients. I always find it confusing with some of these accounts and actions. Some have December deadlines, others have tax filing deadlines in April. And so this is just a basic list of a few common deadlines for some of the more common accounts that we see. Due by the end of the year, December 31st, is 401k contributions, of course, and you must make your RMDs or distribute QCDs, qualified charitable distributions, have that done by the end of the year. Roth conversions must be done by December 31st to count towards this tax year. That's always a little bit confusing because IRA contributions can be done until the 15th, but conversions have to be done by December 31st to count. Most states require 529 contributions to be done by year end. However, Iowa is one of just about a half dozen states that allows contributions to be made up until April. It's actually an April 30th deadline for Iowa 529, and still have that be able to count towards 2021 tax year. We've been talking a lot about IBonds in past webinars and meetings. These are savings bonds whose interest rate adjusts to inflation. A real good option for saving if you have extra cash right now. You're allowed $10,000 in purchases per person per calendar year. And so if you want to contribute more than that, you want to make sure you get a purchase in this year still. 2021, so that in January, the next calendar year, you can make additional purchases. And lastly, one thing that is different for this year, if you've been doing backdoor Roth IRA contributions, so this is if your income is too high for normal Roth IRA contributions and you don't have large traditional IRA balances, a way to get some extra money into Roths each year. Normally, you have until April 15th to do that. However, we've been starting to advise clients that if they have the cash available now, to do these backdoor contributions now before the end of the year. We have a slide a little later on that will talk about some future tax proposals that are floating out there. But one thing that's out there is potentially restricting or eliminating these backdoor contribution strategies. So to be safe, we've been recommending that if you know you're going to do backdoor Roth contributions this year, just make sure to get it done before the end of the calendar year, just in case there's a last minute tax bill that's passed. And next topic, I think this is the last related to any kind of investments or retirement savings. Tax loss harvesting is something that was on a lot of people's radar in about 2020 because of the stock market's decline when COVID hit. But since then, it hasn't been something we've brought up a lot simply because there were not a lot of opportunities. It's a good problem to have, but the stock market's been doing pretty well since then. And as this year closes out, there might be just a few opportunities we're seeing depending on when you made your investment and what you're invested in. So we wanted to make sure to bring that up here. And I will say that if your assets are at Schwab with us, we're checking this for you, so don't worry. But if you have investments outside of our management that are in a standard brokerage account, maybe some old stock holdings or just a kind of fun account, this might be something that you want to be sure to check. If you sell any investments that have declined in value from when you purchase them, you can sell them, recognize the loss, and get a deduction on your taxes for this year. You can offset any amount of gains that you have recognized during the year. So if you have sold other stocks for a lot of gains, this can be a great way to start to offset some of that, the capital gains. And you can also just claim up to a $3,000 deduction for losses too. I'll just say that we have a previous webinar on this topic, so I won't go into a lot of detail on this process here. We're happy to walk through this with you too. Just let us know. But what might be good to say here is where we have seen opportunity to capture losses this year and claim that tax deduction this year is primarily in investments in bonds. With interest rates rising just a little bit, most people have seen their bond positions down, at least a couple % here this year. And so that's a good first place to look. US stocks have generally been doing pretty well this year, so you might not see a lot of opportunities in kind of broader indexes in US stocks, but some international stocks are about 10% off their highs from earlier in the year. And so if you made purchases around the summer, you could see a 5 to 10% decline in some of those holdings now and have some losses to capture. And then lastly, there's always lots of individual stocks that are going to be up or down real big, especially here as we've come out of kind of the COVID environment back into a little bit more normal. And so if you got into any of those hot, stocks when COVID hit, Zoom, Peloton, GameStop, all those have seen pretty good declines now, and you might be able to capture some losses there, get yourself a good tax deduction. Just for example, how this looks is going to depend on where your accounts are at Schwab. This is what I see just in the Schwab app here. And you can see that there's one holding here in particular that there's a loss on. I could sell this, get a $400 tax deduction, and be pretty easy. And so generally you kind of want to look in a cost basis or the gains loss section of your account to see if you're eligible to take advantage of this. For charitable contributions, there are just a few points we want to make regarding charitable contributions for this year. This is our last chance to remind you that at the very least, take advantage of the special $300 or $600 deduction that's available. This is unique because it's a deduction that's available even if you claim the standard deduction. As of now, this will not be a thing in future tax years, unfortunately. So if you commonly claim the standard deduction, this might be your last year to get any kind of tax benefit for smaller donations like this. As a reminder, to qualify for this, you must donate cash or write a check. Items like cars or clothing or furniture don't count towards this $300 or $600 deduction. Then as far as year-end timing, make sure you leave enough time for your charitable checks to get cashed and processed in 2021 so that they count towards this year. There's some wiggle room here if you can prove things like postage dates and things like that, but just save yourself some trouble and get the checks out ahead of time to make sure they have time to go through the mail, which can be a little slow this time of year, and then also cashed and processed by the end of the year. And lastly, if you find yourself routinely donating amounts, maybe just for example, in the single-digit thousands of dollars per year, it might be a good idea to start thinking about bunching multiple years worth of donations into a single year to be able to get a deduction. We'll help you figure out this amount, but just, for example, if you tend to donate $5,000 per year and you don't have a lot of other deductions, you're probably not getting a lot of tax benefit for that. And, while that's not necessarily the most important thing, you might be able to kind of lump 2 or 3 years of donations together and get an added benefit, helping you out, helping the charity out too. So just a good thing to kind of keep in mind, depending on the amount that you find yourself donating every year. Next, not exactly an end of year item, but this is our last chance to tell you that you have until December 7th to change your Part D drug plans for 2022. This is usually a very quick process, 10 minutes or so. And we found that some clients have been able to save a few $100s just by switching plans, looking at either new plans that are available or going through just kind of different plans that are pricing better now. This is good to do every year regardless, but is especially important thing to do if your current drug plan is increasing its prices, if you have new prescriptions that you're taking this year or might begin to take soon, if you've moved, or even things like if you notice a new pharmacy in your area, since they might have better prices on drugs or better agreements with new insurance companies. A quick item here on flexible spending accounts for the year. One rule that was changed because of COVID is that the IRS is allowing much more freedom in rolling over amounts in flexible spending accounts this year to be used for next year. So this can apply to a lot of different types of FSA accounts, healthcare accounts, dependent care accounts, et cetera. In normal years, this can always be kind of that last minute scramble for families who have unused amounts in their accounts. So before you rush off to go buy, a new pair of glasses or something like that this year, check with your plan and see if they're allowing you to roll over money. Plans are not required to allow you to roll over money, but the IRS has simply given them the option to this year. And so you want to be sure that you have the option to roll over these funds before you leave them in there and potentially would lose them if you don't. Where you'll see this will depend on who manages that FSA account. I know for me personally with WageWorks, my wife's WageWorks accounts, they make it very obvious right when you log in that the money's available until March of 2023 now. But if you have any problems figuring that out, your HR can probably help you, or we're happy to help you look through your account as well to see if you have that flexibility this year. For estate planning, there are a few estate planning items that might not necessarily have an end of year deadline, but we just find that the end of the year is a really good time to just sit down and kind of think about your estate planning documents. And so there's nothing super enlightening here, and probably things that we have mentioned various times throughout the year. But we mention these just because we always find accounts that have old beneficiaries listed, maybe an old workplace retirement plan that still has that was around before your kids were born, or have an ex-wife listed as the beneficiary, or old wills that have executors listed who are no longer alive. So this is just a good time to make sure that documents are still in good order, and maybe more importantly, go along with your wishes and make sure that the split in assets, for example, is still what you want, things like that. For your investment accounts, the best thing to do is to make sure your beneficiaries are listed and are correct. And then lastly, there was a change a couple of years ago regarding IRAs that will go into trusts. And so this is a complex topic. So I'll just say that if you have your IRA beneficiary to a trust and haven't had that reviewed for updates in the last couple of years by your estate attorney, it's a good thing just to get reviewed. It's not necessarily a problem, but it can potentially be a problem that leads to some big tax bills otherwise. And then this is our last slide here, but sort of, I think kind of the elephant in the room as we finish out the year. There's a wide variety of new tax proposals floating around Congress. We were kind of hoping when we scheduled this webinar that we'd have a little bit more light on changes that would be coming in 2022 and beyond. But right now, there's just not a lot of concrete information out there for what's likely to change. And so we don't like speculating. We don't think it's worth getting excited about just kind of some rumors and things that might never come to fruition. But there are drafts for legislation out there that could have a big impact on some kind of last minute end of year items, and especially going on into next year. Roth conversions, for example, as I mentioned, a lot of different variations on controlling them, maybe just based on income. maybe account balance, maybe taken away altogether. We don't really, unfortunately, we just don't really know yet, but certainly seem to have the attention of lawmakers. Tax rates are always have the potential. Right now, it looks like maybe just surcharges for very high income, many millions of dollars in income, but that can always change. Some things like same-sex couples may see a really big benefit, allowing them to amend decades worth of taxes and file jointly. Not a topic that's going to cover, millions of people, but if it does impact you or a loved one, could have a really big benefit in 2022 and beyond. So something that we're keeping our eye open for. There's still some increases in the child tax credit and child care credits that are out there that we're looking at, that'll be real important for young families with children. And then lastly, there is a lot of talk on changing the cap in the amount of state and local taxes that can be deducted. This is sometimes called the SALT deduction limit. And right now it's capped at $10,000, which we find a lot of clients of ours hit just between Iowa's tax rates and property taxes and things like that. So this could be a potential benefit in the future for at least our clients here in Iowa, but potentially all over the country. I just bring this up here so you know what's potentially on the agenda for the future. Once we get a real bill signed, we will have a webinar devoted to any of the topics in the bills and go in depth on any implications of any changes. So just know that we're keeping our eye open for that to get passed, and we'll be ready to talk about it whenever and if it happens. And so that's all we had for today. Thanks again for joining us. As Quinn mentioned, as long as no big tax bills get released here, I think we're planning our webinar topic for January to be an in-depth look at kind of your monthly and quarterly investment account statements, what to look for, what to keep track of. And we appreciate the recommendations for topics that we always get from you guys. Thank you. We'll have an email invite out for our next webinar in mid-January, and we'll send out a recording of this here by early next week. And so if we don't talk to you before then, have a very happy holidays and New Year. And thanks again, and take care.